All right, good afternoon, everybody. How are we doing today? If I can get a quick audio and video check, if you can just let me know that we're coming in loud and clear, you can hear me speaking, and that you can see my screen here with our title of Do You Really Understand the Risk and Reward with Nadex Spreads? So if you can just type in the box there and let me know that we're coming through loud and clear, I appreciate it. That way we can move forward here and know that we are good to go. And I appreciate you guys joining us again today. We're kind of doing a two-part series here. Thank you, Mike. I appreciate that. Some of you might have been on yesterday with us as we kind of swung back around to the basics of spreads. And then today, just the day after, we're going to jump in a little more to do you really understand the risk and reward with Nadex spreads? Because in the past when I've taught on spreads, the webinar we did yesterday, people are like, okay, I think I've got an understanding of how spreads work, but then when it, comes down to trading them, it's like, oh, wait a minute. And I want to clear up a few misconceptions and make sure that you fully understand risk and reward with spreads. So let's dive into that. And I'm going to just cover briefly a quick review of what we covered yesterday. If you weren't with us yesterday, what you can do is hop on over and check out the video. I'll show you here in a second where you can find that. So as always, trading futures, options, or any financial instrument involves risk, may not be suitable for every investor, and all trading decisions are your sole responsibility. Also today, guys, or on any webinar, if you see me place a trade in the Nadex demo account, that's just me trying to help you understand what it is I'm teaching you, visualize it, and show you how to actually use the platform. It's in no way a trade recommendation or trading advice, and as always, past performance not indicative of future results. Okay, so what you can do is hop on over to nadex.com. And if you're brand new, you can go through the top tabs here. Nadex basically offers two different products: binary options and spread options. What we're talking about today and what we talked about yesterday was spreads. Okay, and you can go through and get some more information on that here. Right over here under Learning Center, there's some great stuff in here you can check out. But if you go here to webinars, this webinar that we're on right now is being recorded. And this is where all the recordings go. So if you go in here and click on demand, for example, and just scroll down and find me, my name is John Skelton with Apex Investing, you'll be able to find the recorded webinars, okay? And you can go back and check out any of these webinars that you might have missed out on, or if you want to catch up on. But you can go down here. Right here, the basics of Nadex spreads, okay? And you can see that was yesterday, October the 2nd, all right? So if you go ahead and check that out, you can catch up on that anytime, and the same place is where this recording will be as well. You can click upcoming webinars and see what's coming up and so on, all right? Also, you'll see in yesterday's webinar, I kind of walked you through how to go up here to trading platform and go to demo trading platform. Nadex will give you a free $25,000 demo account. Make sure to get one of those. Very important to have one. Great place to practice and test out any new strategies or systems, especially spreads. We talked yesterday. A lot of you guys are familiar with Nadex binaries, but have never traded the spreads. And maybe you're trading binaries in your live account. And as you're getting used to spreads, maybe, when you have a setup on your chart for your strategy or system, you're trading binaries with it, try a spread in demo, okay, until you get used to spreads, okay? Expand your horizons. I always tell people that, I'll talk to folks and they'll say, oh, I trade, I'm a Nadex binary trader, or I'm a Nadex spread trader. Well, I like to say I'm a Nadex trader. Sometimes depending on the setup and the market condition, sometimes a binary might be a better route to go. Sometimes a spread is a better route to go. So don't limit yourself. Learn both, understand the benefits of both, and when to use each. Okay. And once you get a handle on spreads, as I was just kind of showing you here, if you go to this on demand, and again you find me here, you can scroll through and right here, what's better, binaries or spreads? There's a complete webinar on that. okay? And I go through and explain of what type of market conditions might be better setups for a binary over a spread and why, okay? So you can check that out there. And that's where to find yesterday's recording if you missed that. So once again, you know, my name is John Skelton. I'm with apexinvesting.com. This webinar today is brought to you by and hosted by Nadex. We appreciate them having us here. And, you know, like I explained yesterday, they have us here to just help give you some free education information on who and what is Nadex, give you some ideas of, you know, how we trade Nadex, and help you formulate some ways for you to incorporate the Nadex products into your personal trading, okay? And I've been with Apex now for about 5 years as head of operations. I'm a trader just like you, all right? And that's what we're here for, is to help you out, give you some free education there. So yesterday we reviewed the basics. I'll do a quick, just a few minute overview of that. What I want to talk to you about today is making sure you really understand the risk versus the amount of money you're required to put up to enter a spread trade. Okay, and there's, you know, different spreads out there, and, you know, we'll dig into some more of that. But yesterday, you know, we covered real quick the basics of spreads. All spreads, you know, have a top and a bottom, or what's called a floor and a ceiling, right? And we kind of went through this, and it moves in pips or ticks, which is the last digit quoted, and each pip or tick is worth $1, right? And we know that if we're selling, for example, and the market goes against us and goes up, we don't lose any additional money above the ceiling, and we don't make any additional money below the floor. I've talked to you about how if you draw it on a chart, it's kind of like a box, and you're trading inside that box. And the ceiling and floor of that box cap your risk and cap your reward. And you don't get stopped out just because, okay, you know, you don't get stopped out just because the price hits one side or the other, okay? So we went through and talked about examples for, you know, if we sold up here at 24.90, then we've only got 10 ticks of risk between where we sell at 24.90 up to the ceiling of 2,500. And each pip is worth $1. There's 10 pips, so $10 risk, okay? We went through and talked about example of buying. It's the same thing. If I'm buying, I think the market's going up. I don't make additional money above the ceiling, and I don't lose any money below the floor, okay? So we talked about all that. And what I really want to, you know, and we also talked about how we can close out at any time, all right? So, you know, we used the example of, you know, if I bought here at, you know, 24.10 and the market goes up to 24.50, right? I can choose to get out early, right? If I bought at 24.10, the market goes up to 24.50 and I get out, well, then that would be 40 pips, right? Each pip is worth $1, so I would have a profit of $40, okay? So let's kind of do a quick little quiz here and see who all was on yesterday or who all kind of understands spreads here. So this particular example, this spread is 100 pips wide, right? The bottom or the floor is 2,400, the top is 2,500. Okay, so if I bought, let's say right in the middle at 24.50, okay, what is my risk? Who can tell me? If I bought this spread at 24.50, what is my maximum risk? Who can tell me? Yeah, $50, exactly. Because if I bought right here at 24.50, I cannot lose money below the floor, right, Mike? So that's my maximum risk. Even if the market shoots down hundreds of pips, I'm only, you know, my only risk is down to the floor. So the most I can lose is $50. So if I entered this trade, what amount is Nadex going to put on hold out of my account? $50, right? Okay, because with Nadex, the only amount of money you have to put up is the amount of risk to get in the trade, and that is your total risk. You cannot lose more than that, okay? So let me ask you a question here. Everybody understands that, right? So let me take it a step further. If I bought right here in the middle at $24.50, okay, and at expiration, okay, pay close attention here. This next little bit is key to what I need you to understand today. If I bought right here at $24.50 and the market at expiration had gone down 5 pips, and then the trade was closed out. Okay, so I bought at $24.50, market closes at $24.45, and the trade expires. How much money would I lose on the trade? They pulled $50 out of my account to put on hold to get me in this trade. My maximum risk is $50. I bought at $24.50. It ended up going down 5 pips and then expired. How much do I lose? Do I lose the whole 50 because it expired below where I bought it? Or do I only make or lose $1 per 1 pip compared to where I got in and where I got out? Okay. All right, Andrew, you say 45, okay? So I put up $50 to get in the trade, right? Because I bought it $24.50. The bottom is $2,400. So I had to put up $50 to get in the trade. It goes against me 5 pips, and then the trade closes. Do I lose all 50, or do I only lose 5? How much money do I get back out of that 50? I put up 50 to get in the trade, goes down 5 pips against me and closes. Yeah, it's $1 a pip, so I only lost $5 on the trade. I'm going to get back 45 of it, right? Minus fees. Does that make sense? Everybody follow me there. Is anybody lost right there? Say something now if you are, because it's very key. Okay, so I had to put up 50 to get in the trade. It goes against me by 5 pips. I lose $1 a pip. That's it. Okay, so I'm down $5. Now, who can tell me this? If I was trading a binary and I bought a binary at a strike of $24.50 and I paid $50 for that binary, and the market expired 5 pips below my binary strike, how much do I lose? If I paid $50 for that strike, how much would I lose on a binary? Right, I would lose $50. I would lose the whole thing, right? Because a binary is all or nothing at expiration, right? Yes, you can exit early, but at expiration, a binary is either worth 0 or worth 100. Let me ask you this question. If I bought a binary at $24.50 and the market expired at $24.49.999, how much would I lose on that $50 binary? Just because of the 0.999 or the 0.1111. Yeah, I would lose all of it, right? On the spread, if it expired 1 pip below where I bought it, how much do I lose? $1. Everybody see the difference there? I'm not trying to sit here and tell you binaries are bad, spreads are better. No, there's a time and place to use them. But I need you to understand there's a difference. For those of you that are used to trading binaries, you're used to thinking all or nothing based on 1/10 of one tick, right? You agree? So what happens to your head mentally? Well, let me show you. What you do is you come over here and you look at binaries, right? You say, okay, I want to trade a binary. And if I was to get this binary right here, and I want to buy it, whoa, you know, you're like, whoa, man, you're looking at that number right there, aren't you? Max loss number. Yep, and that number right there on this order ticket does what? It controls your mentality, your fear, and your psychology, doesn't it? Because what are you thinking in your head? You're thinking in an instant, at that instant of expiration, I can lose this amount listed right here. I can lose this max loss listed right here in an instant at expiration based on 1/10 of one tick, right? We all do that, right? We all have that emotional side. So then you're like, oh, let me look at something else. You know, maybe I like this one better, and you know, a cheaper. Okay, you know, max loss of 32, and I could potentially make 70. Okay, I like that a little better. It's better risk reward. That $32 number may not scare me so much, right? It may not mess with my head so much to think of losing that in an instant. You know, or you might even look at some of these lower price ones, and you base your decision, you know, emotionally, all because of that number listed right there, right? Can we all raise our hands and say we do that, or we have done that, or we did that when we first started trading Nadex? And that number scares us at times, especially when it's a larger number, right? When it's a larger number and it's a binary, and you realize that you can, in an instant, lose that entire amount based on 1/10 of a tick. Okay, you all see where I'm going with that, right? You've all been there. Okay, so what you have to understand with spreads is, just like the example I showed you a minute ago, spreads do not work that way. They're not all or nothing based on 1/10 of a tick, right? If this market, you know, this binary contract says that euro dollar be greater than 1.1502 at 3 p.m. If it's 1501, you lose that entire 83 bucks. On a spread, if it was 1 pip below, you lost $1 and you get the rest of it back. And you have to make sure you understand that with spreads, okay? Because there are different spreads available to you. Let's take a look here, okay? Let me show you, for example, here. Let's look at, let's say, euro dollar at some spreads here at 3 p.m. First of all, what you have to notice is there's different spreads available, and there's different floors and ceilings. We talked about that yesterday, okay? You also have to look here and realize there's different prices that you can buy each spread for based on where the market is, okay? We'll dig into that more in another webinar, okay? Notice these particular spreads here, and this is just an example of forex. I mean, you know, commodities and indices, you know, different markets have different sizes of spreads. These particular spreads we're looking at here are what? They're 100 pips wide, aren't they? See these? These ones that open on the hour and then expire 2 hours later. Open on the hour, expire 2 hours later. They're 100 pips, okay? And what you have is, you know, this one up here would probably show you a very low risk, okay? If you wanted to buy it, for example, it shows $9. You're like, oh, okay, I like that, great. Well, we'll talk about that more in another webinar, but look at where you're buying it. You're buying it up at 15.26, but the market's down here at 15.16. Okay, so even though it's a lower risk, you're buying higher than where the market is. The market has to make a pretty good move for that to catch up, as it were, okay? And don't get confused by that. We'll talk about that some more. This spread right here, if you were to look at buying this spread, well, max loss about 49, max profit about 54. You're buying this spread right in the middle, okay? Notice you're buying it at 15.15, the market's at 15.14. You're buying right where the market is. So you're putting up about 50 bucks, and your most you can make is 50 bucks, okay? But what about these daily spreads? Look how big these are. 1550 to 1800. That's not just 100 pips wide. Look at this one, 1300 to 1800. That's a 500 pip wide spread. So without even drawing it out for you, if there's a 500 pip wide spread and you buy right in the middle, okay? So imagine a box, it's 500 pips wide or tall, and you buy right in the middle. How much money would you have to put up? If the floor and ceiling are 500 pips apart and you buy right in the middle, how much money would you have to put up to get in that spread? $250, exactly, Mike. Okay, so why? Well, again, if I'm buying a spread, the most I can lose is wherever I buy down to the floor. So if this was a 500 pip wide spread and I'm buying right in the middle around like 250, then I've got to put up $250 out of my account to enter the trade, because where I'm buying down to the floor is 250. Okay, make sense? So, and again, we'll talk in another webinar about why I'd want to choose one spread over the other. But if I'm expecting there's a big, huge move in the market, maybe I want that wider spread, right? That gives me a lot more room to the ceiling to profit, correct? Does that make sense? As opposed to only having just a little bit of room. I might want a bigger spread. I might want a longer term spread, okay? So if I'm gonna, so if I go in here and, I say, hey, I wanna, buy this spread, and boom, what number do I see right there all of a sudden? Max loss 220 bucks. What does that immediately do to your heart rate? What does that immediately do to your emotion and your head when you see that right there on that order ticket? You freak out, don't you? Why? Well, because you're used to looking at that number on a binary and thinking of, I can lose all that amount of money in a single instant at expiration based on 1/10 of one tick, right? So that number right there kind of scares you, like on a bigger spread, doesn't it? Everybody agree? Like your first initial reaction, if you didn't understand spreads, would be to be scared by that and not even look at trading that spread. You try to go find another one. And it might not even be the best spread to go find another one, but you're worried about it because of that amount, right? Everybody agree? Or what if you were wanting to sell the spread and it's like, whoa, $283 max loss, right? And that takes you back for a minute, doesn't it? And you're like, oh, I don't know about all this. Well, what I want to get across to you today is don't be confused about max loss, okay? First of all, you cannot think like a binary trader. It's not all or nothing. It's $1 a pip, okay? There's a difference between max loss and, max risk and planned risk. Let's look at something here. Let me pull up a euro-dollar chart, okay? And let's just say that for whatever reason, I thought that the market was going up, okay? Where's the market right now? Let's look at something here. I really need you to understand this, because if you don't get this, you will not trade spreads properly. So where is the euro dollar right now? Euro dollar is right here at 1.1521. Okay, where's the spread at? Okay, I can buy the spread at 1522, 1 pip difference, right? If I want to buy it. Okay, what is my risk? What is the max loss? 217. So what do I have to put up out of my account to get in this particular spread? 217. What has to happen for me to take that full maximum loss? Who can tell me? Well, if I buy at 1522 and the market expires at 1521 under my price, do I lose all of it like a binary? Or would I have lost $1? Who can tell me what has to happen for me to lose this whole $221? We see it right here, 1521, that's where I can buy it. That's right here where the market is. What has to happen for me to lose $220 on this trade? Yeah, Brandon, the market has to move against me 220 pips. So it's got to go down to what, 1.1300? Like, I have to squish my chart to even find that, right? It's got to go, I got to keep squishing. It's got to go way down here, right? Way down there for me to lose all that. Let's bring this chart in and see when was the last time the market was even way down there or moved that far. Okay? Do you see that? If I'm trading, whatever my strategy or system is, and I had a reason to go long, how about you guys tell me, what is your strategy or system? If you have a reason to go long and buy, well, your strategy or system should have a stop in place, right? Your strategy says, hey, I think this is going up, but if I'm wrong and the market moves down to a certain level or a certain amount of pips, I'm going to get out. Okay? Like, where is most of y'all stop at? Joe Smith says, and this one would be, his stop would be at 1490. Okay? So about what? About 30 pips, Joe? Yeah? Who else? Are your stops on an entry, what? 15, 20, 30 pips? Or at the top of the last high or something, right? Let's flip this around. If we were going short, okay, like if we had been going short here, like, you know, the market's been coming down, it makes a pullback right here, right? And then this bar closes back down, and let's say we entered there. Where would our stop normally be on most systems that are out there? Like most systems that are traded out there, where would this stop have been if we went short here to continue this trend down? Our stop's going to be like a few ticks above this high, or maybe a few ticks above like this last high, right? Somewhere in there. Okay, or Joe on this one says up at 60. Okay. Like most of y'all agree with most systems you trade, not only does your system tell you when to get in, but it also tells you, hey, if I'm wrong, I'm going to get out if it goes back up to this level or to this level, right? Which is, you know, this one here, what, 32 to 44, 12 tick stop. Or up here, like 15. Or like Joe said up here, like 35, 40. Raise your hand if anybody on this webinar day trades forex with a 220 tick stop, because we need to sit down and have a conversation. right? So if I have to put up, I mean, Joe, you agree? I mean, who in their right mind is going to sit here and say, I think the market's going up. Oh, well, I was wrong. It's going down, and it's going down, and it's going down. I guess I'll just sit my butt here and watch it go all the way to the bottom of my spread and watch myself lose 220 ticks. If that's the way you trade, you need to stop trading and go to demo and go to school on trading and do some practicing, okay? Like, I'm making this out to be really ridiculous because it is. There's a difference of, hey, how much do I actually have to put up out of my account to get in this trade? What's the true maximum risk of the trade? Well, the true maximum risk of the trade is to the bottom of to the floor, right? But do you see the difference now of max loss that's listed here compared to planned risk? Can the market flash crash like we've seen it do before, or a few years ago, like called the dollar franc? Absolutely, it can flash crash hundreds of pips. Why do you think I love trading Nadex spreads for forex so much? Because I'm protected. No matter what it does, I cannot absolutely lose max more than to the floor. Okay, right? So just because I have to put up 220 bucks to enter this trade doesn't mean that's my planned risk. My planned risk is where my system rules are. If I enter here to go short and the market starts to go long back up to that previous high or wherever my stop is, I'm going to get out. Where's the market at right now? Or right here when I entered it, it was at 1532. If it came back up here to, let's say, 1550, I'd have got out. What's the difference between 1550 and 1532? 18 pips. So how much would I have actually lost on the trade? $1 per pip, $18. Or even what Joe said, he might have put his stop up here, closer to 1560. Okay, well, if I got in right here at 1530 and my stop was up here at 1560, giving myself a little more room, right, Joe? 30 pip stop. $1 a pip, it's 30 bucks. So yes, I had to get in the trade. I had to put up on hold out of my account $221. But then when I exited that trade, okay, yeah, Joe, that is a little higher than most do, but still, that's a nice stop. And what's the most you could lose? 30 bucks if you get out there, right? So yeah, I had to put up 220 bucks to get in the trade. But when the trade goes against me and I get out, when it went against me those, 18 or 30 pips, I get all that money back minus that 18 or 30 bucks. The point I'm trying to get across here to you is you cannot look at this like you look at it on a binary, because on a binary, that number would scare the heck out of you, because you would say, I'm going to lose 221 bucks if I'm wrong by 1/10 of a tick, and I'm going to lose it in an instant. Heck no. That would, mess you up, right? Mentally in the head, okay? But with a spread, okay, you have to understand that it's $1 a pip, okay? And you have your stop in place in your mind based on your system, and you're ready to manually execute that, right? So in this situation here, had we sold here, our strategy or system tells us where to get out at if we're wrong. We know where that level is. We're sitting there watching the trade, and we're ready to manually exit that order if it goes against us. We have to manage the trade, right? So we have to understand that difference, okay, between max risk and planned risk. And you can't sit here and say, oh goodness, I'm not going to trade those spreads because that's too much risk for me. Okay, now again, I'm showing you an extreme example here of a big, huge spread, right? I also showed you plenty that are not near that much. You know, like these 2-hour spreads here, I can get this one right here and, you know, buy it right there close to the market and put up about 50 bucks to make about 50 bucks. No problem. Okay. Yeah, Joe, exactly. Knowing your risk and money management is crucial. Okay. So I'm not saying you have to trade those big spreads. I'm using that as an example of even if you do. Okay, let me ask you this. Here's a good example. Do I have, if I follow my system rules, okay, do I have more risk in this spread right here? Okay. Hold on, I want to show you something. So, I'm going to tear that off. Give me a second. And give me a second. Oh, man. I want to tear this off here. Tear off ticket. Okay. And let's do this, and let's do this, and let's do this, and let's do this. Okay. So I've got these two different spreads here. This is a 100 pip wide spread. This is a 500 pip wide spread. If my strategy or system was telling me to go long and I was looking to buy either one of these spreads, what am I looking at here? I'm looking at this number and I'm looking at this number, okay? If I'm following my system rules and my system exits and I'm watching those exits and I would manage my trade and manually exit the trade when that level is reached, which one of these spreads has a higher risk for me? Which one of these spreads has a higher planned risk involved? Who can tell me that? Well, on this one, to enter the trade, I have to put up on hold out of my account $226. On this one, I have to put up out of my account $56. Okay? So, if I was going to go long and I was going to buy, okay? Joe, let's say for example's sake, I was going to buy right now, okay? I'm not saying this is setup, this is not a trade recommendation. Where's the market at? 1525. Where would you put your stop at, Joe? In this complete example, where would you put your manual stop at that you would manually be getting out? It's at 1525 right now. Let's say 1505. Yep. Okay. All right. So, how many pips is that? 20 pips, right? If we bought at 1525, we would manually exit the trade at 1505. That's 20 pips. $1 a pip, 20 bucks. We would exit that trade. How much would we lose on the trade? 20 bucks. Everybody follow, right? So I've got two options here. I can decide I want to use this spread, put up $226 on hold to get in the trade on this spread, or I can use this spread, put up $56 on hold to get in the trade. Which spread would I lose more on if it went against me and I followed my rules and got out? It's the same, exactly. It's still 20 bucks that I would be losing if I exited at my exit. It doesn't matter whether I put up 20, 50, or 220 to get in the trade. If I exit where I'm supposed to exit, it's still 20 bucks. Does that make more sense? It doesn't. It's the same level I'm getting out at. Yes, if there's some crazy flash crash and in an instant the market zips hundreds and hundreds of ticks down, sure, I have a potential bigger loss on my one on the right because of the max loss. There's a bigger distance to the floor, okay? But for planned risk, you know, for planned risk and following a system, if I exit where I'm supposed to exit, the loss is still the loss. Brandon, Brandon says that makes sense, 100%. So do you see now the difference of, oh gosh, that scares me. Oh, I'll do that one. Does it really make a difference if you're following your planned management? Well, and do you understand how it's very different from a binary? Because with a binary, if you're looking at it, and you've got this one with a $12 risk or this one with a $75 risk, that's literally all or nothing. At expiration in an instant based on 1/10 of a tick. Yep, and Brandon's absolutely right. It's the same. If you manage it and you exit, it's the same risk, but you've got more upside potential because it is a much wider spread to go in your direction. Okay? So that's the big thing I want you guys to understand today is we covered the basics of spreads yesterday and how they work. And I've seen so many people go in and say, oh, I get it now, but oh man, I only choose those spreads with a real low risk. Well, those are not always the best spreads for you. And we'll talk a little more about that in some other webinars, or they might be the perfect spread for you. Or Joe made a comment like, hey, what about, NFP days, right? Non-farm payroll and big news events where the market can flash and move quickly. Well, in one of those situations, Joe, that might be where you want to say, hey, this spread up here, I think the market's going to go long. This spread up here, I can buy this spread and only risk $12 with a potential of 91. Now, I'm buying it at 15.28. The market's only at 15.23. So I'm buying it above the market, meaning the market's here. That's, that spread has a what? What would you want to do, Joe, if it was some big news announcement like that, for example, and you've got a 100 pip spread and you're worried about flashes, but expecting a big move, you could look to find a spread, potentially, this is not advice, I'm just saying, that has a what? A floor, a bottom that's close to where the market is, right? You think it's going to blow up and go up, but if you're wrong and it blows up and goes down, you don't want a lot of room to the floor, right? That way you have lower limited risk. Make sense? You've got some insurance there, right, Joe? You've got some protection there. And for that protection, you might have to pay a little bit of what's called premium, to where you're going to buy it for around 15.30, but the market's only at 15.24. So you've got that protection. You're only risking $9, right? But you know, where you're buying is, you know, up here. So that first little move of the market up, as it's starting to move up, you're not necessarily making $1 a pip on that, are you? Until it kind of all catches up here. It's going to move a little slower at first. You're going to give up a little bit of that first part of the move because you bought a little higher, but your risk is only $9. Make sense? Okay. So, and we'll talk about that a little more in another webinar about how to pick the right spread. Okay. But does that help shed a little bit of light, guys, on why you should never pick a spread? Yes, Joe, I'll show you where that's at. Why you should never pick a spread or not pick a spread just based on that max risk number. You have to understand what that max risk number means and understand the difference between max risk and planned risk. And you cannot think like a binary trader. It's not all or nothing. Okay? Does that help, guys? That kind of a building on what we talked about yesterday and help you really understand the difference again between binaries and spreads and how it's all about risk management and following your strategy or system and doing what the chart's telling you to do. Okay? Okay, for a couple of you have asked, and Joe, you were just asking what you want to do if you want to relook at yesterday's webinar. Yesterday, we covered Spreads 101, kind of like, hey, let me hold you by the hand and treat you like a 5-year-old, and you've never even heard of a Nadex spread. What is it? What are they? How do they work? Okay, and what you do if you go over to nadex.com, and you just go right over here to Learning Center and go right here to Webinars, okay? And what you would do, give me a second here, is go right here to On Demand, all right? This is where the recorded webinars are. This is where today's webinar will be. Click On Demand and then go right here and find me, John Skelton with Apex. Okay, see that, Joe? And you can see all of my past, you know, a bunch of past webinars here. But if you just go down to the bottom here, Joe, and then you go to page 2, scroll to the bottom, right there. See it? October the 2nd, Basics of Nadex Spreads, right there. And you can watch it from yesterday. Okay? So, all right, guys, I hope that helps. I hope that helps get you some clarity and understanding. Again, make sure to hop on to nadex.com. If you don't have a demo account, sign up and get one now. Start utilizing that. Start practicing that. You know, hop over here and check out some of the upcoming webinars. Get registered for those. You can get reminder emails as well. Utilize this library of recordings here. It's just a wealth of information on Nadex binaries and spreads. Okay. Guys, thank you so much. I really enjoyed us doing this 2 in a row here and helping kind of answer your questions and build on what we're covering. And we'll do some more of that here. So have a great rest of your trading week. Sign up for another webinar. We'll see you on the next round, guys. Thanks so much, and thank you for your input. I appreciate everything.